Every insight deserves an audience. Welcome to Atypica AI.
Nvidia is now worth $4.6 trillion. That makes it the most valuable company on Earth. At the end of 2026, if you own tech stocks, work in AI, or run enterprise IT infrastructure, this single fact should change how you think about your next decision. Because here's what most people are missing. Nvidia's dominance isn't just a success story to admire from a distance. It's actively reshaping where your money goes, what technology you can access, and whether you're building your business on solid ground or a trapdoor controlled by someone else. I spent the last several weeks interviewing investors managing billions, executives at Nvidia's direct competitors, and enterprise buyers responsible for AI procurement at Fortune 500 companies. What I found contradicts almost everything you're reading in financial headlines. The consensus view is that Nvidia is invincible because of something called CUDA, its proprietary software platform. Analysts are screaming strong buy. Revenue projections show 63% growth for fiscal 2026. The order backlog is $500 billion. The narrative is simple. Nvidia won, game over. That narrative is dangerously incomplete. My research shows the very thing making Nvidia dominant today is creating the conditions for its eventual margin collapse. And if you're making decisions based on the surface story, you're setting yourself up for expensive surprises. Let me show you what's actually happening. Start with the numbers everyone knows. Nvidia controls between 70 to 95% of AI accelerator sales globally. In data centers specifically, where the real money is, they own 90% to 92% of the GPU market. Their gross margins are 73%. For context, that's almost unheard of in hardware. Apple, the company everyone thinks of as having pricing power, runs around 45%. Nvidia is printing money at a rate that would make oil companies blush. The reason everyone points to is CUDA. It's a software ecosystem that Nvidia has spent 17 years building. If you're a developer working on AI, you learned CUDA. Every tutorial, every code library, every optimization trick, it's all built on CUDA. Switching to a competitor means rewriting your code, retraining your team, and accepting that some things just won't work as smoothly. That's what we call a moat in business. The deeper the moat, the safer the castle. But here's where my research diverges from the bullish consensus. I asked every expert I interviewed the same opening question. What is Nvidia's most overestimated strength? Every single person, the investor, the competitive executive, and the enterprise buyer, gave me the same answer: CUDA itself. You're probably thinking, wait, didn't you just say CUDA is their competitive advantage? Yes, and that's exactly the problem. Here's what I discovered. When you build a moat so deep that customers feel trapped, you don't just create switching costs, you create enemies. And those enemies have budgets. I spoke with Dr. Anya Sharma. She runs product strategy at one of Nvidia's major competitors. She told me something that should terrify Nvidia shareholders. She said, the window is opening wider. What window? The window for open source alternatives to CUDA. Here's how this works. Every major cloud provider, Amazon, Microsoft, Google, Meta, are now actively funding open source AI software frameworks, not as a side project, as a strategic imperative. Because they've done the math.
When one company controls 90% of your critical infrastructure and charges whatever they want, you have two choices: accept it or fund an escape route. Amazon has already built its own AI chips. Google has TPUs. Microsoft is designing custom silicon with partners. These aren't hobby projects. They represent billions of dollars in R&D specifically designed to reduce dependency on Nvidia. And every dollar they spend weakening CUDA's lock-in effect is a dollar that erodes Nvidia's pricing power. An enterprise IT buyer I interviewed, I'll call her Eleanor, manages AI infrastructure procurement for a company you've definitely heard of. She said this, and I want you to hear it clearly. The perception that CUDA creates an absolute and unassailable lock-in is precisely what drives us to mandate diversification. Read that again. The strength everyone thinks is permanent is the reason sophisticated buyers are actively building exit strategies. Now let's talk about what this means for Nvidia's financial performance. Those 73% gross margins, they're unsustainable. I talked to Shay, an investor who manages a tech-focused fund. He tracks something most people ignore: the actual negotiating behavior of Nvidia's largest customers. And what he's seeing is a fundamental shift. When Nvidia's top 10 customers account for the majority of revenue, and 8 of those 10 are now developing their own chips, the power dynamic changes. These aren't small buyers calling customer service. These are hyperscalers who can credibly threaten to walk away. Shay told me he expects Nvidia's gross margins to normalize toward 50 to 60% over the next 18 to 24 months. That's still excellent by hardware standards, but it's not 73%. And when you're trading at the valuation multiples Nvidia commands, margin compression of 10 to 15 percentage points doesn't just trim the stock price, it revalues the entire thesis. Here's the mechanism. As open source software gets better, the performance gap between Nvidia's chips and competitors' chips narrows. Not because competitors caught up in raw speed, but because the software layer, the thing CUDA used to monopolize, becomes hardware agnostic. When that happens, buyers start making decisions based on total cost of ownership, not just benchmark scores. And on total cost of ownership, Nvidia is vulnerable. Dr. Sharma's company is winning deals not by being faster, but by being 30% cheaper on power consumption and offering rack-scale solutions that reduce data center complexity. Eleanor, the enterprise buyer, confirmed this. She said, TCO is central to our evaluation now, not just raw performance. So here's the conclusion my research forces me to. Nvidia will remain the market leader for the foreseeable future. That's not in question. But the nature of its leadership is changing from a monopolist that sets prices to a dominant player that competes on value. What does that mean for you? If you're an investor, stop reading analyst price targets that assume margins stay at 73% forever. They won't. Start tracking the adoption rates of AMD's ROCm software platform and the percentage of AI workloads major cloud providers run on their own silicon. Those are your leading indicators. When you see sustained momentum there, that's your signal that the market is repricing Nvidia's moat. If you're making enterprise IT decisions, do not wait for competitors to reach feature parity with Nvidia before you start diversifying. That's backwards.
Start pilot programs now with alternative hardware. Build internal expertise with different software stacks. The goal isn't necessarily to replace Nvidia entirely. The goal is to have credible alternatives so that when you negotiate your next contract, Nvidia knows you have options. Eleanor told me her organization is already doing this, and it's changed the pricing conversations immediately. If you work in AI or build products on these platforms, recognize that the era of just use Nvidia because everyone else does is ending. The companies with the best long-term position will be the ones who design their systems to be portable across multiple hardware backends from day one. I know some of you are thinking, but Nvidia keeps beating earnings. The stock keeps going up. Why should I believe this? Because what I'm describing isn't about next quarter. It's about the next 18 to 36 months. The companies I interviewed are making investment decisions today that will reshape competitive dynamics in 2027 and 2028. Stock prices reflect current earnings. My research is about the structural forces that will determine future earnings. Nvidia becoming a $4.6 trillion company is real. It earned that valuation through genuine technological leadership and exceptional execution. But the mistake is assuming dominance is permanent. It never is. Every moat eventually gets bridges built across it. The smart money isn't betting against Nvidia outright. The smart money is preparing for the margin normalization that's already begun. Based on my research, here's what I'm watching. When Nvidia's gross margins dip below 65%, that's the confirmation that pricing power is eroding. When open source AI frameworks hit 20% adoption in enterprise production environments, that's when CUDA's lock-in breaks. And when hyperscalers start publicly touting cost savings from their own chips, that's when the narrative shifts from Nvidia is unstoppable to Nvidia is a great company in a competitive market. That shift is coming. The only question is whether you're positioned for it.
Want to learn more about interesting research? Check out Atypica AI.